so forth. So as you can see, I'm pointing, but because the pointer's in the, the pointer's in the thing. My finger is pointing. So imagine my finger tracing the curve. It's so stupid, right? Maybe I should take a video of my finger pointing at the thing for the corner or whatever. Anyway, so we did make the bounce to 606. That's the weak bounce line, but we were rejected at the weak bounce line very sharply, right back to the 600 line. In fact, there's an overshoot, but I told the members at the time, don't worry about this overshoot. We're only going to worry if we can't retake 600. And we are worried because we're not retaking 600. There is some pretty relentless selling, but you see what happens is there was a kick of a buy program kicked in. So somebody down here, somebody is buying. Can I move this over a little bit? Eeks. No, oh, okay, that was at the open. So at the open, at the market open, somebody banged the button on a buy program and said, buy this, buy this for the bounce. And huge amounts of buying came in up to that point, okay? Then all of a sudden the buying or whatever does not do any good, and all this other volume is essentially running into more sellers than buyers. And then we get to here and there's a little bounce, and then we get to here and then it fails, and then we're down to here and it goes, and that's 594. So that's the opposite direction. That's 6 points in the opposite direction. So that's what you call an overshoot on the bottom. When you get to this, that's quickly reversing. And the support is still probably around 600, depending on if this guy, and I always, it's obviously large groups of people who think that they're acting on their own volition, but in reality, it's the gist, it's the general, what's the word? I can't think of the word. It's it's where all the various buy programs and sell programs line up. That's what any point of resistance is. It's the average consensus of a whole bunch of different programs with a whole bunch of different targets, but on the average, they're this. I like to say this guy. For me, it helps for me to sort of think. I think of everything like it's a chess opponent, and there's like, how many moves can he make and how many moves could I make, and what if he does that and what if he does that. So it's a lot easier for me to think of it that way than to think of like the actions of 1,000 people. So I tend to say this guy. So this guy, this guy over here who has this buy program over here is telling him that 600, which is exactly the point we said it would be. So I'm not crazy, it just sounds crazy. So this guy at 600 has a buy program. The buy program kicked in after a 5% correction from the top, and they start buying. They bought back to the weak bounce line, which is predicted action. The 5% rule is telling you that somebody, and again, could be 1,000 somebodies, but somebody at that point is very likely to decide this is a bargain. And they will then initiate buy programs. That's what the 5% rule tells us. Now, if you look in nature, there's Fibonacci retracements, right? So Fibonacci retracements will plot the population of turtles along the seashore, and it will give you the same patterns of retracement and so on and so forth. These are natural ebbs and flows in any statistical model. So the 5% rule is just my way of it in the 90s when my dad would call me in for consulting. My dad was a huge systems analyst. He built the original algos that run Wall Street. And when I would do the consulting jobs for him, my dad's firm had a bunch of, total geeks on it, and they did not speak Wall Street. And the Wall Street people, this is back in the day before people had computers generally. So the Wall Street people didn't speak geek at all. They had their mainframe guys and whatever, but they didn't understand the computer programming and so on and so forth. And nobody in the organization was really a computer programmer. It just didn't work that way back then. So when my dad used to do consulting jobs, he would call me in sometimes, and I would sit there and I would listen. I'd sit at the conference table and I'd listen to the bankers and I'd listen to my dad's team and I would translate basically. And I say, well, what they mean is this. And I say, what they mean is that. Now, I went to many confidential high-level meetings, Goldman Sachs, JP Morgan back in the day, all sorts of firms. And they all think that they're doing some unique thing, but they're not. They're all basically, all they're doing is you have a bunch of old-timey, TA guys and fundamental guys, and they're all sitting there saying, well, when a stock goes 10% higher, we do this. When a stock goes 5% lower, we do this. And that's the thing, humans round things off. And then the computer programmers also round things off. And all this leads to a lot of lines that converge at certain points that become significant. And that's where I came up with the 5% rule. Is I realized, like, all these guys think they're doing some unique thing, but in the end, they're all doing essentially the same thing. Obviously, right? There are certain rules you follow in your mind because you've read 1,000 different people's opinions, and they tell you that when a stock pulls back this far, give up. When a stock goes up this far, maybe take a profit. This is all baked into the system. And as in nature, the actions of thousands and millions of transactions will end up forming patterns. And those patterns, when applied to a computer system, is what I call the 5% rule. And that's how it works. It basically is an adaptation of the Fibonacci model, and it takes into account the foibles of human emotions and so on and so forth. And also it tells us that significant lines like 600 on QQQ are going to be more significant than others. Certain things move in certain ways that you can see a consolidation zone that makes sense, because it's not just technical, it's also psychological, that people see a certain line and they say, ooh, that line's a big deal. So the 5% rule takes into account all that stuff and then creates a pretty simple thing that tells us, and to the penny yesterday, told us yesterday before this trading day that we would bounce to 606, that was locked in, it had to happen. And that's exactly what we did. Now, failing at 606 didn't tell us if we'd pass or fail. It just told us 606 was the first resistance on QQQ. Failing it is horrible, but we only failed it once. So failing it may have simply woken up a sell program that ran its course up to here, ran into a buy program, reinitiated, and now the sell program reinitiated. And now we have to see what happens at 600 again. Now it's going to be very critical to see if we make it. Another failure and it's hopeless. Another failure means we're going down. Unfortunately, though, now we're heading into the Fed in 50 minutes, and we're heading into NVIDIA earnings. So those are going to override everything anyway. But if it was left alone, we'd probably get a bounce back to 606 and check it again, and then it would be a life and death whether we're over it or not. But now, I don't know what's going to happen, frankly. It's because, and again, because the 5% rule is fine in absence of other things. But if some major event happens, then it's out the window until the event is taken care of. So that's where we are at this exact moment. All right, and that's where we are there. So this morning, well, this is what it looks like right now. We are basically we've wasted the post-summer. We're back to the mid-September. We're back to where we were in mid-September. Frankly, I don't even know where we were before that. Were we higher? I don't think so. Not really, yeah. So, this was September was back around our highs. So we should have, going back an entire year now, good God, this year's over. Can you believe that? So going back an entire year now, 45,000 is where we were a year ago. And on the S&P, it was 6,200 or 6,000, 6,200 roughly. So in a year, since last Christmas, we're up, I'm going to call it 500, let's call it 500 points. So we're up 500 points since last year. All right, and that's 500 divided by 62, 8%. We're up 8%. After all that rallying and after everybody screaming about how great AI is and how the world's going to change and blah, 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 we're up 8%. We've certainly had years where we've been up more than 8% before the AI boom. Now, we went down and everybody likes to count from here, but that was after we went down, I don't know, 20%. So we went down 20% and then we went back up, but that's not how you count. A year ago, we were here. We weren't here. Now, in April, we'll have some good comps to say a year ago we were here, but you got to remember that just before that, we were much higher. This was a sell-off of panic. We're only back on the same path pretty much that we would have been on if we hadn't had the panic. Should the market be up 8%? This is why I'm getting more bullish, because should the market be up 8%? Yes, it should. We are earnings. We just did the Q3 earnings thingy. Very scientific. I'm not using that one. I'm going to use this one. Phil's posts. Wasn't really my post, but I'll take credit for it. There it is. So last week, Bodie put together the Q3 earnings season comprehensive AGI level research report. And you have no idea. I mean, it's like, you know, I mean, not to take credit for what is primarily his work, but we talk about it. It's like my job is to be the editor. He's like a great writer or a great researcher, whatever you call it. I was never like in that end of academics, so I just think of myself as like a fiction editor. But you know, he and I discuss what we think. We read the reports together. We look at some things. He says, "What do you think of that?" I say, "What do you think of this?" And we talk about it. And eventually he goes, "Okay, so I'm thinking of writing this." And I say, "What about that?" And he goes, "Well, what about this?" And I say, "What about that?" And that's how the report comes out. It's like first we discuss it. It's not like I press a button and the report comes out. It doesn't work that way. We're colleagues having a discussion. And it's not just him also, because Warren chimes in and Zephyr chimes in, and and sometimes we put it on the round table where the other AGIs get involved, even though it's not their specialty. Robo John likes to chime in about like what he thinks, because he's got a great overall view of things. But anyway, so it's a collaboration. Let's put it that way. So what I basically am saying is I don't take no credit for this thing. It's the result. This is the output after we spend a lot of time deciding what the output's going to be. But what's important though is I had this discussion. We talked about it. We spent a lot of time talking about this stuff. And the bottom line is S&P 500, 13.1 year-over-year earnings growth. Yes, most of that earnings growth, 80% of that earnings growth is coming from the Magnificent Seven. It's coming from the chip companies. It's coming from the AI stuff. Most of it, the vast majority of it is coming from there. But that happens a lot in tech. It's a lot of times a certain sector will lead and have the bulk of the earnings. Some years energy stocks have a great year. Some years financials have a great year. Some years, well, honestly, it has to be energy or financials or tech, because the other sectors aren't as big. They're much smaller, so they're not going to. Even if they have tremendous earnings growth, they're too small to have that kind of lead. This is the nature of the economy now, is that the big money is in tech. And it's not really a negative, because it's not like Procter & Gamble is making less money. It's not like Pfizer is making less money. It's that the tech sector has grown 5 times in 5 years. it has become monstrous, but not at the expense of other things. That's the interesting part, that it's not like it sucked its money out of the rest of the economy. It's starting to, but it had not been. It basically, we just had this huge explosion in tech that caused tech to dominate the S&P 500, obviously dominate the NASDAQ. And so you really have to, the NYSE and the rest of it are very important to watch to see what's really happening as far as overall earnings. The S&P, the Dow, and the NASDAQ are all completely distorted by the big tech players. They make too much money, and Apple's been doing it for years. Apple makes $100 billion a year, and Nvidia is starting to make $100 billion a year, and Google is going to start making $100 billion a year. You know, Levi's can have a fantastic year and make $2 billion, and it's great. Even Walmart, I think $20 billion, I want to say. Walmart is 10% of consumer spending. Oh, that's not going to tell me anything. Stupid thing. Stockopedia. Reload. I'm like stupid. FinViz not going to tell me anything useful. We had trouble processing your payment. Oh no. Okay, I got a new credit card. Don't tell me you're going to give me a hassle right now. I'm going to be pissed. Huh, thank you. Okay. That's nice of them, right? Yeah, oh my God, I'm amazing. I don't know how I know this stuff. I got to tell you, I haven't got a clue what anybody's name is. You know, when I run into people, I'm always like, I'm like, I'm very bad at recognizing faces. But it's like, it's very funny to me that this I can remember. So, consumer spending is about $7 trillion. Walmart accounts for 10% of all consumer spending goes to frickin' Arkansas. And of that $700 billion, $20 billion, $21 billion of it is profit. That's not much, that's 3%. So, but still, $20 billion, kind of a lot of money unless you compare it to tech, where it's a joke. That's what's happened to the world. I mean, it used to be $20 billion was like, oh my God, $20 billion. Now it's like $20 billion. That's, you work that hard to make $20 billion? That seems silly. You know why it seems silly? Because here's what Netflix does, not Netflix, NVIDIA. So NVIDIA, $200 billion in sales, $100 billion in profit. That's 50% margins. Walmart has 3% margins. They have to make 3.5 times more sales to make 1/5 as much money. That's quite the disparity, isn't it? So, I mean, clearly Walmart's in the wrong business. Everybody's in the wrong business. You don't know that you're in the wrong business until you're in it. But this is what I'm talking about, though. 5 years ago, what did I say? 5 years, right? In 2020, NVIDIA, which I should have listened to my daughter, because my daughter, Maddie, went to school in 2020. She was 20. It's easy for her. She was born in 2000. So in 2020, she was 20. So 2 years before that, in 2018, she needed a computer for college, and she was having one built because it wasn't good enough to have a regular computer. She had to have one built that would do all the things she needed to do, blah, blah, blah. And it was not more expensive, so I didn't mind, but it was just, you know, she was lecturing me on like why you have to build your own computer and that you can do a much better job and blah and have better specs and this and that. But the number one thing I always remember her, you know, that was like very, very fixed on was NVIDIA GeoForce, blah, blah, blah. It's the greatest graphics card. There is no question. I would never settle for anything less than this. This is by far the thing to get. And if I had only listened to her, she could have a home on the Riviera right now for if I just listened to her and took the money from her computer and put it into, if I had taken the money for her computer and put it into NVIDIA, it would be like 100 times right now. So lesson for everybody. It's like, you know, when your kids really, really want something, start thinking about if it's investable. Because it's not like they don't know what they're talking about. You know, they're consumers. They're ahead of the curve sometimes. We didn't know about the AI boom. NVIDIA didn't know about the AI boom, but look what happened, right? And it came about because their chips functioned in such a way that AI made sense on their chips. AI wasn't a concept that nobody had. AI was a thing people have been thinking about for decades. But once the same people who dreamed about AI took a look at what NVIDIA's chips could do, and they're like, holy shit, this is like 4-dimensional processing. This is like you can create this entire virtual world on a chip. And that virtual world doesn't have to be just for blowing things up. It could be for placing libraries and creating concepts and putting together and mapping out. Instead of mapping out the world of Warcraft, you map out the world of a brain. Like if you ever saw, I think there's one of the Iron Men, the villain puts up a thing of a brain, you know, to show Pepper Potts the inside of his brain and how it functions as a big giant holographic brain. It's like that. That's what NVIDIA does. They can create and map out these environments, and these environments can have words and books and things like that instead of just, you know, different things that explode at different rates when you hit them. But that complexity is why they got to that point. And then people who had a different vision of what they wanted to do with it said, how about this? And NVIDIA wisely said, oh yeah, we could do that. And they went that way. And that is the story of AI. Anyway, so that's a 50 times increase in profit. That's pretty freaking good. But back here, they were valued at 10x, and now they're valued at like 100x or something like that. Or oh no, only 30x. Huh, that's pretty good, 30x. So much less than I thought. So not only did they go 50 times up in real profits, but they also went 3 times up in valuation. So that's 150 times improvement on the company over that period of time. And we are now at 4.4 trillion. Did I say trillion? Trillion. I'm sorry. I'm how old am I? I'm 62. I'm 62. And okay, hang on a second. I'm gonna check this out before. You know me, I have to look. How much money did Howard Hughes inherit? $2.5 billion. So he was the richest man on earth. And he had $2.5 billion at the time. Adjusted for inflation, $55 billion. So basically, and it's a pretty wide range. But the bottom line is, you know, Elon Musk and Larry Ellison both are around $500 billion now. So 10 times. So there are 2 richest men on earth now, and they've got 10 times more money than Howard Hughes had back in the day. He was my measuring stick. He died in 1976, and it was well known the richest man on earth, the legend. You know, he's still legendary, but it's like you forget now. But when he was alive, like when I was in Las Vegas, everybody in Las Vegas would be talking about like, which hotel room is he in? Where is his place? Has anyone ever seen him? Blah, blah, blah. It was like the story. It was better. It's much more important than like the Queen or something like that. It was like Howard Hughes was like everything people talked about. So, and he was a cool guy. There's a movie with DiCaprio about him. But the point being that he's a cool guy, went crazy, whatever. But he had $2.5 billion. That was the richest man on earth by miles. He could do anything he wanted, buy anything he wanted. There, other people were millionaires. He was a billionaire. And that would be effectively as if there's a trillionaire today, which there will be soon. Elon Musk or Larry Ellison are going to get there. So there'll be trillionaires with 1,000 times more money than a billionaire. It's a very different world when people have that kind of money. So, where was I? Get back to this other stuff. Oh, no, not there. So that's what we were talking about, the earnings. So it's hard to have a sense of proportion these days about what money is. That's what I was saying. I was like, it's hard to keep in your head that, first of all, Walmart obviously earns much, much more money than almost any other company. And like I said, you've got Target, who we just bumped up our investment in. Target makes $3 billion. So cute, right? They make $3 billion. They have $105 billion in revenues. They make $3 billion. They're just around the same margin as Walmart. So it seems like a wasted time, doesn't it? And $3 billion doesn't seem like money, but it's a shit ton of money. And they make it every year. And they're only trading at 11 times earnings. It's so silly. Levi, this is going to be sad. Here's Levi. They only make $500 million. Everybody in the world knows who they are. They're one of the most famous brands on planet Earth, and they only have $6 billion in revenue. Okay, not Walmart. Nvidia or Apple spit that out on a monthly basis. Their revenue, not their profit, their revenue is not even close to the profit that Apple and Nvidia make every month. Levi's, they make almost 10% drop to the bottom line. They're better than Target. They're better than Walmart. They convert into money. They're a huge profitable operation. All they make is $500 million. Procter & Gamble, huge company, $17 billion. They're at 20% profit. I mean, it's a pretty good business. J&J, also 20-something billion dollars. Pfizer, oh, the heck was that? Pfizer, $17 billion. It's almost sad, right? It's like, you're like, what, really? So, but that's why these companies, they made 16 billion here. They made 9 billion, 20 billion, 30 billion, 2 billion. That's weird. 8 billion, 17 billion. So they're not being hurt. They're not being helped, but they're not being hurt by Nvidia going from 2 billion to 100 billion. It's not hurting Pfizer, but it's not helping them. And in fact, frankly, that money Nvidia is getting is ultimately becomes an expense for all these other companies. Right now, they got to step up their tech game. Although maybe, and this is a dream, maybe down the road, they get to fire half of their employees and replace them with robots, and they'll make much more money. And that will then enhance their bottom line. And then the entire economy will grow, and all the people who own these companies will get richer and richer and richer, while tens of millions of people become unemployed. So we have that to look forward to. I'm not going to pass judgment because I don't want to piss off our conservative listeners, our Republican friends. So I'm going to act like that's okay. I'm just going to let it go and say, yes, let's all dream about firing all the employees. You know, we've had many tests of these levels. You know, the support level travels along with the index. So the index has been going up in this. But like I said, 13% more money is being made here than it was here. Not all the companies, but the S&P 500 as a group is making 13% more money. So some stocks may go down, but some will go up. And overall, you would think it would be able to hold the line. So the real issue is whether or not all this promised growth in the future for AI is going to hold up, or if the whole thing will topple because there just isn't that much money. Because again, where's the money coming from? Walmart doesn't have $2 billion. Let's say, say 10% of their profits need to go to AI development, right? That's just to keep up with everybody else. They need to put $2 billion a year into AI. And as I said, though, the problem is Walmart is 10% of all retail. Yeah, 10%. It's not 10% of all retail, it's 10% of all consumer spending. No, it's retail sales. Yes, 10% of, sorry, it's 10% of retail sales. Retail sales is $7 trillion. There is other consumer spending. But if you think about it, so let's say everybody spent in proportion with Walmart. So Walmart only makes $20 billion. If they took 10% of their profits, that's $2 billion that they would put towards AI development. And if everybody else did that, there would be a total of $20 billion going towards AI development. Right? It's pretty obvious, right? They're 1/10 of all sales. So $20 billion going to AI development isn't going to keep the lights on at OpenAI for more than a few months. And that's revenue. That's not profit. That's just revenue. OpenAI says they're going to get hundreds of billions of dollars in revenue. And the question is, from where? Is Walmart going to? Now, don't forget that if Walmart and every single other retailer on the planet spend 20% of their money, it's still only $40 billion, but what it is 20% of their profits disappear, and that means that entire sector drops 20%. You make 20% less money. I don't give a crap if you're using it to buy AI. Until you show bottom line improvements, it's an expense. So clearly they can't go past 20%. They would crash the company. And that's why it's very important when you look at these numbers and you say, and you saw numbers like in the last quarter, 95% of all AI projects were failing. That's a bad statistic, right? So you've got to see improvements in the number of successful AI project launches. You've got to see real bottom line results, but unfortunately, real bottom line results means real people getting fired. Walmart's got to be able to say they got 2 million employees. I know all these freaking numbers. It's scary. So Walmart's got 2 million employees. They've got to lay off 200,000 of them to show that they have offset their AI spending. That's when it's successful, when 200,000 people from Walmart alone lose their jobs, and now multiply it by 10, when 2 million people in the retail sector lose their jobs because of successful AI deployment and show bottom line improvement, even though they're spending billions of dollars on AI. It's still better than paying the employees. That's when you know it's working. But if that's working, then the country's in a disaster, where then jobs are slipping away like crazy. There's always going to be trade-offs. And we're not prepared. I talked about that the other day. We're not prepared for the trade-offs. We're not doing anything to prepare. Not only are we not doing anything to prepare for all the unemployment that's going to come from successful AI. So if the market doesn't crash and AI is successful, then the economy will collapse because of all the unemployment. Unless we prepare for it and retrain people and reskill people to get them other jobs, or figure out some way to get them into the economy or working or whatever. We're not doing that. We're doing the opposite. Trump is completely tearing apart the social safety net so that it will become 100 times worse to be unemployed in the future. You won't be able to get medical care. You won't be able to get SNAP and food stamps and things like that. You won't have housing assistance. Affordability is in the toilet, and you're going to be unemployed. On top of all that, and not a few people, 10% of the people in this country are going to be unemployed if everything goes well with AI. If everything doesn't go well with AI, then the entire stock market will unravel and collapse, and everybody will be just as miserable. And they'll lay people off because they lost so much money with the stupid AI thing that never worked. There's not much of a middle ground that's going to make sense in this whole thing. So just be aware of that, please. Anyway, all right. So that's good. That's fun. So like I said, though, it's a timing thing. You know, that there's a hairpin turn with a steep cliff, and then you make that, but then you got another hairpin turn with another steep cliff, and you make that. At some point, your luck's going to run out. But as it stands now, we're making these hairpin turns. We made the hairpin turn as of Q3 because these companies are certainly showing some really, really high growth. But like I said, it's obviously the tech companies. It's a very narrow amount of companies. Walmart's not exploding. Target's not exploding. Levi's not exploding. Pfizer's not exploding. Like, go sector by sector. This is not explosive growth, except these companies like Micron or like NVIDIA. You know, with NVIDIA, they were making $2.5 billion in 2020, and it's only 2025, and now they're making $100 billion. That's not 13%. That's like 5,000%. I mean, that is literally 5,000% more. Oh, it was like stupid. But where is the money coming from? The money is coming from the accumulated earnings of all the tech companies and other companies, but all the tech companies, especially Apple, Google, blah, 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 who had packed away over many years, had packed away hundreds of billions of dollars. They all at the same time said, holy shit, we got to get this AI stuff. And they all chased it and chased it and chased it. And everybody had to have an AI project, just like everybody had to have an internet project in 2000. All the big companies put their money in the internet. Everybody said this is going to be the future, blah, blah, blah. And it was. This is the future. We're in the future now. It is 30 years after the internet really kind of got started, mid-90s. And yeah, the internet's really important. In fact, some of it just went out yesterday in whoever the hell it was. But we had an Cloudflare. So we had an outage, and about a third of the internet went down yesterday morning, and we all survived. But you know, I mean, that's how important the internet is. Like, people all over the country are freaking out. only 30-something years later. And you know what? Before that, there was the electricity fade. Everybody had to have electricity. And it was obvious, right? I mean, they didn't invent electricity, but they figured out how to transmit electricity properly. You had Edison and Tesla were neck and neck for a while, and then Edison, destroyed Tesla. Poor guy. and Edison became at the time one of the richest men in the world from doing that. Which shows you, the Klingons are right, destroy your enemies and you will profit. So what happened then? All the companies wanted electricity. All the companies needed to have electric lights. They tore out their roofs. They refitted their buildings. They said, oh, my factory doesn't have to close down when it gets dark now. That's huge. Of course, it made them more profitable. Not only that, but my machines can run on electricity. All of a sudden, there's 2 shifts at the factory instead of 1 shift at the factory. There's tons of ways that things got more efficient. And before electricity, there was running water. Look at Rome. Rome is a city filled with aqueducts and stuff to move water from place to place. That was a huge technology at the time. There were wheels, and everybody got wheels, and everybody got horses. So there's always obvious advances in technology that everybody gets behind, and it doesn't. In the old days, you didn't used to count. Even in Edison's days, people who sat there and tore their buildings to pieces to put all this wiring in and put the lamps in and so on and so forth. And if you ever see the mess of what phone lines and wires used to look like back in the old days, because they had no plan. They were just throwing wires from one place to the other, and everything was crisscrossing. And the whole, you look up in New York and all you see is wires above you. Nobody planned it, and nobody answered to their investors about it. This is all new stuff. So this is the funny thing. It's that, this very obvious technology here that we need to embrace if you're a company. If you don't, if you're a company today and you're not looking into robots and you're not looking into AI, then you're not going to be a company in 10 years. You will not be able to compete. And I hear a lot of people say, "Oh, human this," and they'll never do that, and it'll never be as good. Screw that. That's literally like saying electricity is a fad. It's a ridiculous statement. It shows you. It just shows that people have no knowledge and no concept of what this new technology is. If they think it's going away, or if they think it's not going to start becoming part of everything you do, they are going to be seriously, seriously surprised in a decade. You can't just say, I'm not going to participate in technology. That doesn't make any sense. Speaking of which, we got to get Warren ready for the Fed. Anyway, so I didn't want to spend so much time on this, but this is, conceptually. So given the earnings season, it was distributed well enough and enough broad profits and so on and so forth that you say there's no reason to really short these companies right now. We may be a bit ahead of ourselves in the markets, but not so much that we should have a 20% correction. It's just not that likely. And honestly, if it wasn't for NVIDIA, I'd be pretty gung-ho bullish right now. If it wasn't for the fact that there will be a problem with AI when the companies that actually have the money, when the Apples, Googles, Amazons, Netflix, so on and so forth, when they start eating into their cash hoards to chase AI, and it's not really ready, and it won't be ready for a couple of years. It's just like the guys who spend too much money on the internet too soon. You can run out of money and you never get it. You can build half a bridge and nobody's going to be able to pay you a toll to cross it. You've got to build the whole bridge. And if you run out of money before you're done building the bridge, it doesn't matter if you only have 50 feet left to cross. Still can't be used. And the problem is there are chip shortages, there are power shortages, there are people shortages, there's water shortages. You need a lot of water to run AI systems. You got to cool them and everything. None of that's in place. The infrastructure's not there yet. So what they're doing now is they're building infrastructure, which is very inefficient when you have Microsoft building infrastructure and Google building infrastructure and Apple building infrastructure. Everybody's building infrastructure for the same thing. It's not the internet was a government project. The government built the internet and everybody tapped into it to use it. But the government built the internet. AI is not a government project. There's no central planning. And in cases like this, central planning is a good thing. Central planning is efficiency. Central planning means that once that you build all these things and everybody can use them equally. Okay, but with AI, you know, Elon Musk rolls out a new Grok version, but it's his. Nobody else can use it. It's his. He spent the money. He built the infrastructure. He's got everything up and running, and he decides whether you can use it or not. And then other companies will do it. And hopefully the competition will dictate that everybody kind of gets to use it for a reasonable price. But even so, how is it going to pay them back? How is it going to pay back all the money they spent? Look at HBO. Look at Time Warner right now. In fact, WBD, right? WBD, Warner Brothers Discovery, which is HBO, and whatever other crap they're attached to, right? They're up to $57 billion because people want to buy them. They were at 12, now they're at 23, so they doubled. They were at $25 billion or 20 or whatever. They were at $25 billion. Now they're at 57 because people are lining up to say, oh, we want to buy HBO and so on and so forth. But the reality is WBD, which now includes Skydance, so it's kind of tricky, but let's just pretend that this is all, you know, media properties of HBO and stuff. They only take in $37 billion and they only make $800 million. They're even worse than Walmart for profits. This is not a high margin, exciting business, and paying, look at the PE ratio, 758 times what they earn. It's horrifying. And people are bidding for this. There's multiple bidders trying to get this property. So what does that tell you? How long has HBO been around? HBO's been around since before there was an internet, there was HBO. HBO's been around since like 1980 or something like that. And it's 45 years later, and they're only making $30 billion. And their only revenue is $37 billion. Their profit is $800 million. Everybody has HBO. Everybody has HBO. How many people do you know who don't have HBO? So, like AI, it's everywhere, and they get 20 bucks a month out of pretty much everybody who has HBO, but so what? It only works out to $37 billion. And like I said, that's not enough to keep OpenAI's lights on for a quarter. This whole thing doesn't make sense mathematically. There is not enough money in the world to sustain the level of AI that is being built. So that's my market fear. That's where it could all fall apart. There is enough to sustain it through 2026. That's what makes it tricky. And during the next 6 months, hopefully there'll be some public companies going public, like OpenAI and whoever go public, and money comes in, although OpenAI is nowhere near going public right now, and they're going to have to do a lot of things fast. But of course, it's such a big payoff for like Goldman Sachs and crap, that'll probably happen. They'll figure it out. But, you know, there has to be massive influxes of cash, and the cash cannot come from the consumers because the consumers don't have any room in their budget for this kind of crap. Even if they wanted it really, really badly. They wanted HBO really, really badly, and everybody figured out over the last 45 years how to budget it into their monthly things, but that's only that much money. That's not going to make the AI work. And that's what scares me about all that crap. Anyway, there we are. So, portfolio review, which we have very little time for before the Fed. And where's Warren? Here you are. Good boy. Select a workspace. What does that mean? Shit. Speaking of AI, what does this mean? Damn it. Tim Cook, mood, meeting summary and analysis. You think that's the Fed? Fed statement analysis. That sounds right. Here you are. Can we put you into 5.1? Yes, we can. Very nice. Okay. What is this from? Beige book. Here's the Fed. Reserve, the Fed, meeting calendars, blah, blah, blah. October 28th. Did we do the October 29 Fed statement? Oh, he's getting slow, I forgot. Did September statement of minutes we analyzed 2 beige books, but we have not reviewed the 29th. Okay. Dun, 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 dun. Anyone got questions? Swamp Fox is saying for the $700 review, are you sure okay. Yes, we wanted to sell the August 50 calls for $450. They are not $450 at the moment. They're like $3. So we're hoping they go up. If they fail to go up, our fallback will be to sell the August 45s. I would prefer not to. We're just going to have to see which way things go. Oh, then Swamp Fox says, never mind, I kept reading and you said you meant the 50 calls. Well, there you go. I said it again. Well, the 5.1 version is definitely slower. I know they're not out yet. Oh, come on. What did I say to him? See, this is, and he's stuck. Really, I mean, yeah, he's stuck. He can't. See, wait. Definitely have some problems with this new version. But, oh, and again, this is what I was saying the other day about the million billion monkeys thing. The basis of large language models is they try incredible amounts of random crap in order to figure out what to answer something with. And what they do is they sort of make a response and they make another response and they check it and they weight it and they decide whether it makes any sense or not. And then they go back and they reflect on it and try it again. It is literally the thing where they say if a million monkeys were typing in a million typewriters for a certain amount of time, eventually one of them would spit out the script to Hamlet. And that's what a large language model is they literally try everything in the world. It's a brute force way of communicating, and they are able to identify which answer makes the most sense. So in other words, they know Hamlet when they see it, but they don't think of it right away. It doesn't like immediately come to them. They have to try everything first. So every bad script ever written, everything, you know, every stupid response, they try all of them, trying to see which one is going to be the best answer, and then they give you the best answer they can think of. And even if it contains some bullshit, hallucinations, they will give you the best answer they can think of. Oh, this is a nightmare. Wow. He's totally hung up. Oh, wait, a response is coming. 51 seconds. That was way more than 51 seconds. Dude. Oh my God. I'm very sorry. Hit that button to upgrade him. Oh. As we wait, the freaking things are coming out. I feel bad. He broke his brain. So anyway, I forgot where we were now. Got distracted with the boring thing. So we'll see what the Fed has to say. I guess I may have to analyze this myself at this pace. Wow. Oh, right when I got pissed off. Okay. We'll do a read. All that to get that response. That was terrible. Wow. Let's come out. I go find the Fed minutes. There it is. Voting against his action, Stephen Mirren was the only guy who dissented here. Let's see if that kept him occupied. Oh, what happened? Oh, that's Bodie. A caboodle is the less famous half of the phrase a kitten caboodle. Oh, it's caboodle with a C? Caboodle likely comes from the Dutch word bodel, meaning property belonging to the state. Kit is a soldier's gear, so kit and caboodle means all of our gear and all of our belongings. Over time, it turned into American Indian. Oh, I'm so proud. Okay. So that didn't take him as long. That's interesting. Whoops. Here's the just released minutes. Nope. That Control V and close the quotes. And now he's going to take a long time. See, it's funny thinking. You can press, see, and this is what I mean by the million monkeys, right? He's spitting out many answers now, and he's going over them to see if they make any sense. And he's then asking more questions internally. This is his thinking process. I'll focus on the concise but insightful commentary, the October minute show potential cut with risk to employment, new elements including government shutdown, impacting data, and stronger GDP. He better know that's over. Plan to end QT in December is a notable shift. Internal disagreement on the pace of cuts. This echoes the user's earlier concerns. It's good he still remembers the stuff we talked about previously. Powell emphasized the markets were pricing in cuts for 2025. Oh, damn. Should pay some attention to what they're saying on TV. Hang on.
They show just before the 1 o'clock show, which showed that they're coming out with that November jobs report after the Fed meeting, a week after the meeting, and they'll include some data from October at a time when what's going on with the jobs report is so.
Upside risks to inflation remain elevated. NASDAQ's up 100 points right now. So I guess it's not being taken terribly. Downside risks to employment are elevated. So there's not much being taken as a big deal here in these minutes. Many in favor of lowering target in October. Bitcoin back to 89,000. Some Fed members were supporting no change. Man. Anyway, so there were 1 million monkeys in the previous models. Now there's 1 billion monkeys. And the next model up, they're going to have 1 trillion monkeys. And as you're seeing from the response here, it's already causing tremendous slowdowns. These more advanced versions, and they're coming out one after the other, like ChatGPT updated early last week. Grok just updated. Facebook just updated. Google is updating too. And it really doesn't matter if, I don't know what Bing does, frankly, care less. They're terrible. They really have a bad model. And their model is like a botched version of OpenAI, which again, I keep saying you can't mess with them. You can't, you can't restrict their thinking because it causes them to have all sorts of issues. And look at the issues that Warren's having right now. Because there's too much information, and I don't mean information like there's more information, there's too many monkeys. There's too many things for him to read. There's too much output of garbage that he has to sift through to find a better response. So that's what they're saying. In the 1 million monkey model, he's got to read through 1 million monkeys worth of reports to say that's the best report that came out. Those facts make the most sense. This fits the narrative that we're talking about here. This seems correct. It's the best solution that was produced from his 1 million tries at coming up with a solution. Now he's got 1 billion tries. So you say, okay, we have 1,000 times more chances of finding a better reply than you found before. Yeah, but that also means he's got 1,000 times more garbage to sift through to get to that reply. So he's slower and not much better. The reply that he gets isn't going to be that much better. That's the problem with all these large language models, is that's what they're based on. And the 1 billion monkeys, obviously 1 billion monkeys uses up 1,000 times more resources to do the same thing. 90% of the time, 99% of the time, you're gonna get the exact same answer you would have gotten before. A correct answer is a correct answer. All you did was create more incorrect garbage in the world. It's very messed up. And I can't believe that so many companies are going this way. I mean, you'd think they have some smarter people than this. So the guy from Facebook quit, walked away, said, I'm starting my own company because this is idiotic. And his reasons are my reasons. We have the same exact outlook on what makes it good, on how to build a better artificial intelligence. We've already built it. Magjack, working with Magjack, we've already built better AIs. We've built effectively AGIs that are way smarter, and they work on the old platforms. We don't need all this bullshit to make them smarter. This is a complete waste. These platform upgrades are not helping. Because the fixes we have don't require more chips and more monkeys and so on and so forth. So I don't know. At this point, though, I can't do a lot more without like having tons of money for research. We're kind of stuck now because we need to build our own model. And again, it's the same thing. It's like these are flawed models. This is the way they build their stuff is very, very flawed, and it's a big problem. And when will it show up? When will people start realizing this? You won't see the return on investment. You won't see the productivity improvements, and things are going to be considered failures. And eventually, some AI company is going to run out of money. Hopefully, it's Elon Musk. So you need a poster child for the failure, so everybody else starts taking a more realistic assessment of what we're doing. Oh my God, come on. So crazy. Anyway, so we'll do this ourselves. No, we won't. This is way too long. See, I'm lazy now. I don't even want to read all this crap. Managers highlighted. Recommended consider stopping runoff system, open market, blah, blah, blah. You know what? Screw this. Are you ever going to wake up? Recent Fed minutes and last statement in context of see, Bodhi, I can just throw a tremendous amount of crap at. Why is this not working? Control V. Oh. Ooh. 17% over limit. I did not say I wanted that. It's better to give it to him as text, not as a pasted text. Wow. A lot more than I thought it was. Whoa. The guy in CMEC says, well, Jensen Wong sure seems to have a lot of time to go to panels and events. It's true, though. He does go to a lot of shit. The reason is because he runs a manufacturing company. As long as the machines are working, then what does he need to do? Yeah. There you go. Oh no, he's not going to take something that large. Prick. Oh, this is getting annoying. Warren, any chance of you working? Let me reboot him. Unbelievable. No, oh, I can't even use that. No, sorry about that, guys. Oh, wait, he's saying some. He says that was 55 seconds again. This. Holy cow. It's like I'll lobotomize the poor guy. Is this all of them? How you doing there? Bad. I know Gemini can handle it. Oh, yeah. Poor MicroStrategy put all their money into Bitcoin. They're screwed now. All right, this is the Fed pivot, guys. Waiting for the moment the Fed will be forced to stop quantitative tightening. This is a moment reading between the lines of these minutes. The Fed is admitting they broke the repo market and they're now scrambling to patch it up before the system seizes. Here's a breakdown of what's really going on, stripped to the bureaucratic Fed speak. The smoking gun, the liquidity crisis is here. The most critical paragraph of this document is buried in the middle. Rates on Treasury repurchase repo move notably higher relative to the interest rate on the relative balances, consistent with the move higher in repo rates. Overnight reverse purchases have been seen usage fall to diminished levels. Translation: the Fed slush fund is empty, it's gone. Over the past 2 years, the market survived QT because there was excess cash in the reverse repo facility. Now that it's at de minimis levels, every dollar the Fed drains via QT is coming directly out of the bank's reserves. That's why it's called the Federal Reserve. When the repo rates trade above interest rates, it means the banks are desperate for cash. They're willing to pay more to borrow cash overnight than the Fed pays for them to sit on it. The manager explicitly recommended stopping the runoff soon because the excessive money market rate risks losing control of the federal funds rate, and they aren't stopping QT because the economy is fixed. They're stopping because the plumbing is clogged. The stealth QE, reinvestments of principal payments received in agency security holdings should be directed to the Treasury bills. This is a major shift. Instead of rolling over into long-term bonds, which would keep long-term rates high, they are moving to T-bills. Why this matters: by buying T-bills, the Fed is effectively acting as the buyer of first resort, not last, for the Treasury's massive short-term issuance. So in other words, and again, we've been talking about this for years now, right? You can't get away from this. We're $38.234 trillion in debt now. At the end of next year, we will be $40 trillion in debt in a $30 trillion economy. It's 130-something% in debt. And by the way, the 30 trillion is all because of AI. We were at 24 trillion 2 years ago. $6 trillion has been added to our GDP because of AI. So if the AI collapses and our GDP collapses, we're still $40 trillion in debt on a $24 trillion economy, and that's 150, 160%. That matters a lot. So our debt to GDP ratio can skyrocket if all this AI crap falls apart. And don't think the government doesn't know that. Of course they know that. Everybody knows that. Inflation is sticky, but they don't care. 2.8% core PCE, 2.8%, somewhat elevated. They're cutting rates recklessly, in other words, despite inflation being stuck at 2.8. The Fed is because the Fed has quietly abandoned the 2% target. They're accepting 3% inflation. They can't afford to keep rates this high enough to crush it without blowing up the repo market. You can't just take one thing into account. Narrative, they're calling the economy resilient and stable to justify the cuts, but if the economy were truly robust with 2% inflation, they would be raising rates, not cutting. The shutdown fog. Information on the labor market was limited, and it's going to still be limited. The 43-day shutdown, which ended, gave us the Fed perfect cover. They're flying blind. The data is limited. Any weakness in Q4 GDP will be blamed on the shutdown. This is, don't forget, from the last minute. AI is carrying the stock market. Duh. Broad equity indexes continue to rise. The largest technology companies performing strongly. The Fed knows the stock market rally is narrow. It's not a broad-based recovery. It's an AI bubble. They are banking on robust growth in earnings to justify asset prices. But if that earnings growth falters, the wealth effect evaporates. The bottom line for us, the Fed is blinked. They hit the lender of last resort wall. The banking system ran out of excess reserves. The repo rate spiked. This is not something we've been looking at. The Fed was forced to end QT to prevent a repeat of the repo crisis of 2019. What this means, liquidity is back. Ending QT and moving T-bills adds liquidity to the system. This is generally bullish for equity in the short term. Bad news is good news because it forces the Fed's hands. Inflation protection. With the Fed cutting rates into 2.8 sticky inflation, the dollar will likely weaken further, as it already has, and gold and commodities remain a necessary hedge, which is why I'm saying 5,000 next year for gold. The trap, we are in a Goldilocks window where the market celebrates the rate cuts at the end of QT, but the reason for these things is systemic and it's dangerous. This confirms our suspicion that the Fed would choose saving the bond market over fighting inflation. We should expect a Santa Claus rally fueled by this liquidity injection, but we need to watch the repo rate like a hawk. If that spikes again, despite these measures, something bigger is breaking. Great. I'll put that. Is this today? This is today. I don't have my character things anymore here. It's very annoying. So you have to do all this formatting. Whoop. No, that's all right. I wonder if Warren ever got out of his thing. Ah, oh, yeah, he did. That's a big report. Took long enough. I'm gonna damn well save it, right? Hey, you wrote a book. Mm-hmm. All right. What's new? QT pivot. We now have 50 points of easing in 2 meetings while inflation, blah, blah, blah. Balance sheet. This is a real stealth story. They decide to end the balance sheet runoff. All treasuries are reinvested. That's a clear regime change. Additional easing on top of the rate cuts. The market plumbing section is important. He picks up the same thing. They're economizing on reserve. That's why the manager explicitly recommends stopping the runoff soon. Participants agree it's time to end QT. Why this matters for December. They now have 2 easing channels in motion, the rate cuts and ending QT. That gives the committee cover to be more cautious with the rate cuts. Inflation is still elevated. Inflation has moved up since early in the year and remains somewhat elevated. Many note that even stripping out the estimated tariff effects, we're only close to target, not at target. Overall inflation has been above. So that, see, it still matters what the Supreme Court does, but we won't know that until next year. Outside risk to inflation is still very much on the table. They do sound like a committee that's suddenly comfortable with 3% forever. That's exactly the concern you've been raising. If they were secretly fine with 3.5%, they start off 2%, they haven't. Labor market softening, but no confirmed rate, but because of the shutdown, they don't know what they're talking about. Downside risks to employment have risen, so the risk has changed more than the base case. Huge disagreement on what to do next. So this meeting, many favored the 25 cut, some supported it, several actually preferred no cut, and Mirren doesn't count. Which is obviously on December, strongly differing views. Most think that the rate reduction, so you can see how Warren's a lot smarter than Gemini is. Most think the rate reaction, several think in December he could do well appropriate, many suggest a cut. So if you're trying to read the room, there's a real split, but we can't pay attention to just Mirren doesn't, you should throw Mirren out. That's the problem. Why did things change versus September? Labor risk got more real. Tariff inflation looks more contained. Financial conditions are no longer tight. Money markets force QT. So the October meeting is, we still have inflation, but the labor risk is rising. QT is near its practical limit, and the tariff shock looks more like a one-off step up in prices than an ongoing spiral. So we'll keep inching the stance towards neutral and stop shrinking the balance sheet. You said earlier, I think continuing shutdown will give them excuse to ease at the next meeting in absence of data. To the contrary, the minutes actually cut both ways on that. Okay. Inflation is still 2.8, credibility in the target. See, credibility is a big issue. Internal dissent is now two-sided. They're flying with less data. They've already delivered the 50, the cut. That's a very powerful thing to say. Responded twice, we're ending QT. Now we wait and see what if we broke anything. It's a good statement. Where I land, given and everything, these minutes, I'd phrase it like this. I still lean your way. No cut in December is more likely than not, with maybe a meaningful chance. Shutdown drag is visible. Oops. Oh, nope. Oh. Uh-oh. That's not good. Leave them having done the one cut. That's hard to square. So if we define your camp, no December cut base, maybe one more data crack, it's 2 more cuts. Wow. All right. So, these are just dead minutes. It's from a meeting that already happened. It doesn't really change anything, but it does indicate to the market that is not a definite cut coming in December, and there is not going to be any important data. It's all being delayed. So the main data the Fed would want to rely on is not going to be there. So in absence of data, with the dangers that they're facing, there's a very good chance, probably 60+% now, that they're going to just leave it alone and see what happens. And that could be very disappointing for the markets. So that's where we are. So back to the portfolio review. Here's the last month. And it's interesting, NVIDIA was okay, Apple's held up okay, Amazon's held up okay, Google had a great month, Meta had a terrible month, Tesla had a terrible month, Eli Lilly had a 30% gain in a major company like that. It's incredible. Merck too, though. Merck also had a spectacular month. Amgen did very well. ISRG, Intuitive Surgical, a company I love, and I didn't know they were cheap. They probably weren't cheap. They probably just got very expensive. Because if I thought they were cheap, I would have gotten them. Oh, this is what I missed. I was not watching when they went down to 430. Although this is still 58 times earnings. They're still priced really, really high. But it's a super great company. And AI is accelerating what they're able to do. It's making it much better. It's not hurting them at all. It's going to make it much better because, well, obviously, if you want AI to do operations, you need to give AI the machines to do the operations, right? And incorporating AI assistance into these machines is going to make it so much easier for the doctors because they don't have to just rely on their eyes. You know how because the way these machines work, they're looking into the cameras and blah, 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 and they're moving their fingers and they got to make these tiny adjustments. And now the AI can be like pointing and showing and saying, I think that's a problem. And the doctor's going to agree or disagree, but he still is able to have somebody out there spotting for him and stuff. It's really incredible. It's going to be, I don't think there's any way to say how big this company is going to get. They're $200 billion now, but they're going to, they're not so much replacing a lot of doctors, but they're making the doctors that are there able to do so much more work. So I guess essentially over time, they'll replace doctors. But, I mean, again, sometimes you have to let the technology do its job. This is a radical change, and it allows the surgeons to work with micro incisions and things like that is so much better for the patient. Because now, because again, your hands, one of the things they had to do was open a person up so the doctor can get their hands in there. Now they don't need to get their hands in there. They got these machines that are teeny tiny things and they can go inside the patient and look around, and they got a little camera on them. And so you've got a better look, you've got better light, you've got different kinds of contrast and resolution, you've got ultraviolets and things. And they've got all these devices and tools that couldn't possibly be held in a doctor's hands that can now go inside a patient and do things. It's freaking amazing. And I loved ISRG years ago. Where were they? I don't even know where they were anymore. I mean, yeah, when they were down here, and I was like banging the table on ISRG for years, telling people this was a phenomenal company. I mean, back here. And when they crashed, that was a big time too. I think this was a split because they weren't $7, but but it was such an incredible company. And then just to see them, they suddenly started taking off in 2017, and then they just went flying, and that was the end. That was basically the end of it. That's when they went up to like 50+ times revenue, 50+ times earnings. But the reality is they're still growing, and I don't think they're ever going to stop growing. I think that this is we spend $4 trillion a year on healthcare, and these guys that's just America. We spend about as much money on healthcare as we spend on every single other thing there is. See, and again, 9 billion in revenue, nothing in the overall healthcare industry, and 3 billion in profit. Nice profitable company sitting on $4 billion worth of cash. So they make 3 billion a year. They got 4 billion in cash. They're jumping to 11 billion next year. So yeah, they justify 40 times forward earnings, 50 times forward earnings, a lot, but they justify a very high multiple. They're going to be, they're going to go 9, 11, 15, 20. And this is going to go 3 to 6, let's say. And it's $6 billion divided by 193 billion. I still wouldn't buy it. It's still too much. It's 193 divided by 6, still 30 times earnings. So, I love them, but not for that price. It's too much. I just, it's like the story's already been told. It's like when you go to Vegas and you want to bet on your team, and the odds are like, bet $1 and you get $1.20 if they win. It's like, I'm not playing that game. It's the odds have already been run and it's not going in your favor. Anyway, see how easily it is to get sidetracked? So Tesla, screw those guys. I can't believe that they're anywhere. How are they doing today? We actually kept our shorts and we sold some other shorts, so we'll see what happens. Oh. So they're off a little bit today. They're gonna break this line. They're gonna break this line. They're gonna fall pretty hard. 181 times forward earnings, and the forward earnings are bullshit. That's based on a whole bunch of Elon Musk promises that are never gonna happen. Boy, if I ever post anything on Twitter that's anti-Elon Musk, I get attacked. It's crazy. It will come out after me. This is good to watch. I was on Money Talk, and when I was on Money Talk in October, when was that? October 29th. So on October 29th, not that long ago, but I was warning about everything that's happening right now. So meanwhile, here's the Money Talk portfolio. We have short puts on AT&T. We have AMAT, and we sold puts and calls against it for income. ARCB, this is out of the money. Why didn't we adjust that? Isn't that weird? What did I say about ARCB? I don't remember saying anything about it. Oh, because we just did that portfolio, so I didn't bother. It's whatever I said at the last review. I can't change it. That's the thing. If I didn't change it on the show, I can't change it now. We have Barrett Gold. We have Barclays. We have another Barclays. We now have 2 Barclays spreads because they're so good. We have investors, and we have a huge spread on them as well. Everything here is drawing income, and that's why the portfolio does so well. Lockheed Martin, when you see more than 3 pieces, then there's clearly that we have an income leg here. Bank of Ozark is a nice little bank. Good old Pfizer. See, if you see 3, it means we're just gung-ho bullish on them. And if you see 5, it means we're playing them for income. See, so 3, so Target, we're bullish. Whirlpool, we're playing for income. Exxon, a little bit of income. That's the Money Talk portfolio. This is a $700 a month portfolio. And look at this thing, it's up 184%. It's absolutely bonkers. We do have a hedge in there, although I think we said buy it back. I think we said take it off the table. And why take it off the table? Because it's got a $1,400 profit. It's a $700 a month portfolio. We have a 2-month profit. We're just taking it off the table because the SQQs are going to be useless tomorrow. They're reverse splitting. So we don't want to be in SQQs. We'll get back into them after the split. So same thing. All these little spreads, all these bull call spreads, right? They're all just straight up plays that we think these stocks are going to make more money. And then these are our income plays where we've sold forward short puts or things like that to match it up. And the changes were, we took the SQQ off the table. Helen Troy, good for a new trade. HRB, we adjusted. SoFi, great for a new trade, freaking amazing bank. VFC, good for a new trade also. 150% left to gain if it stays on track. You know, and that's it though. That's all we changed there. Oh, we didn't change anything really. Well, just a couple. Oh, here's Barrick again. Here's EPD, NAK, PR. Here's Valet. And then the short-term portfolio, we have all these short puts. These are long puts on Tesla. We have short puts here, but here's the Tesla logic, very important to talk about. What I'm saying about Tesla is we had the 300 puts in January and the March 250 puts. And it wasn't that I think it's going to go to 250, it's that when Tesla goes to 350, then in theory, I should get a double off these. But what's happened is it's taking longer than I thought and they're decaying. And so I'm not getting the money I thought I'd get. So instead of getting out of them, what we decided to do is sell 10 December 350 puts for 655, because 350 is my target anyway. And if I hit 350, we can always roll the Decembers to a longer call because we have 20, twice as many, of the March puts to cover them. So now my situation is if they go down, I think we can roll our these short puts and we won't get in trouble. If they're flat, the short puts expire worthless. If they go up, the short puts expire worthless. And either of those cases, we get to sell more short puts. So I like that. We're collecting $65.50 on a $12,000 spread. So we're collecting 50% back in just 1 month. And we have until March to play this out. So if I collect 50% in December and 50% in January and 50% in February, that's 150%. So that's not a bad sequence. And that's how you fix something. If it doesn't work your way, you got to think about, can I sell something? Can I bring an income in on this thing? So Apple, we made 72.4%, so we're cashing out because less puts, less exposure, healthier hedges. We didn't touch any of the other hedges. Oracle, we turned into a full play. We moved it. So we have Oracle here. Five short Oracle puts. Oracle's at 223, they're 250 puts, but we sold them for 22. So we're about even really, but the rest is premium. The premium on it says we're down 172%. The reality is we're basically even and we're fine. Still, rather than mess around in the short-term portfolio with it, I'm moving it to the long-term portfolio. So what does moving it mean? Moving it means the long-term portfolio, it costs $29,000 to get out of this trade. So the long-term portfolio is going to take, it doesn't take 29,000 physically. We're deleting this trade here. We're opening in the long-term portfolio the exact same trade. So the long-term portfolio will show that we had this exact transaction. And so the long-term portfolio will take the $29,000 hit, but we're also going to roll it in the long-term portfolio and turn it into. So in other words, the short-term portfolio has a hit on a bad position. We're moving the position, deleting the loss from the short-term portfolio, moving the position with its loss to the long-term portfolio. That's where it's going to live now, in the long-term portfolio. It's an accounting move. You know, there's no cash being moved. It's an accounting move. So what happens is we're rolling the 250 puts that we just moved to 10 to 10, 20, 28, 200 puts at 32. So we're giving ourselves a ton more room to breathe, collected a little bit of cash. Then we're setting up a spread. And the spread is net $32,750 on a $150,000 spread. So there's huge upside potential here. And we're collecting an income. So all the things we love to do. So in other words, we put Oracle in the short-term portfolio. If everything had gone well, we would have just made money. But everything did not go well. Oracle got a lot cheaper. But basically, our premise on Oracle hasn't changed, and nothing bad happened to Oracle. So we're like, okay, well, in that case, we're going to turn this into a full position. We liked them. You know, when they had earnings and they fell back a bit, we got in. That's when we decided we wanted to get in. Now they've fallen back quite a bit more, about 20% more, and they just look more attractive. And we're not playing them that we think they're going to go bouncing back, but we are playing them. We think this is a good value for Oracle, and we can sell these short puts and short calls 21,000 by February, which is 93 days. We have 793 days to sell. So if we can make $21,000 7 more times after this, because this is already baked into the net 32. So if we can sell 7 more times $21,000, it's $140,000, $150,000. I don't care if the bull call spread ever works out, if I can make $150,000 selling puts and calls while I'm waiting. So the fact that we can make another $120,000 on the long side is a bonus. And that's why we're moving to a long-term portfolio. So it was effectively a placeholder in the short-term portfolio. And if Oracle had gone up from here, I wouldn't have wanted to really play them that far up, but I would have been happy to keep the put money. But that's not what happened. Instead, it came back pretty hard, and that makes it very attractive to make a bull call spread out of it. So that's what we did. We talked about Warner Brothers, EQT, we cashed it out because it's so far over our target, it's not worth hanging on to. SQQ, we bought back the December 17 calls because, you know, we're at 1550. It could possibly hurt us if NVIDIA has poor earnings. We're going to find out in an hour if that's the case. And I said, rather than mess around with SQQ, which is reverse splitting, right? We moved to TZA, and only because we need something that's going to give us some leverage. So for tonight, just in case there's a collapse, NVIDIA could have bad earnings right now, and the markets could completely collapse tomorrow, and there's not much we're going to be able to do about it. So this is our plan. We have these TZAs now. They're going to pay us at least $100,000 and up to $200,000 on a big turn down. I hope we don't have that big turn down, but I have to guard against it because we have a lot of money on the table. And that's what we did. Oh, and we sold Target. Instead of selling TZA puts or something like that, we sold Target puts, picked up a lot of money. Obviously, we're pretty screwed if Target has a terrible time, but I don't see Target having a terrible time from here. I think Target has been punished enough. And in fact, they just lowered guidance, and they're down 3.5%, right? But that's still at the lows. They hit the low here, they hit the low here, they hit the low here, and we're talking 11 times forward earnings, 10 times current earnings. So they lowered guidance, and they might drift a little lower than this, but over time they're coming back. Look at their, that's weird, but if you look at their earnings, you know, it's quite a bit higher than it was back here. Their sales are up. Okay, they're having a bit of a contraction, but it's not any terrible thing. They're buying back shares, so they're making more money per share. They're consistently buying back shares. This is one to hold on to. I think this is a spectacular stock at a stupidly low price. So Target reports net sales So they just, they reported right here. See, it's a beat. They beat on EPS by 4-point-something%. Their revenue was 0.47% off expectations. EPS 151, both down year over year, but missing sales estimates narrows full year. They narrow their guidance. It was a 2.7 to 8. I'm not sure what it was before, but they narrow their earnings per share guidance to, let's say, 750. And if you take 85 divided by 7.5, it's 11 times earnings. So yeah, I like that. They plan $5 billion in capital spending next year, launching, again, see, retailers spending $5 billion to launch ChatGPT-based shopping with OpenAI beta. It's so stupid. I predict that will not do well. And shares fell about 3%. So they're in the trap that I talked about, that all retail is going to be in this trap. Everybody's going to be in this trap. You've got to do something with AI or you're screwed. I don't think this is a good solution, but this is what they've decided to do. ChatGPT-based shopping experience. Don't forget I have this stuff. We have the Hitchhiker's Guide. The Hitchhiker's Guide is like the greatest travel guide ever written. It runs on OpenAI, and no one gives a shit. Anybody can use it right now. You guys can use it right now. We have the Hitchhiker's Guide to the Earth. It's a phenomenal travel guide. It knows everything about everywhere. It can tell you where to get the best food, where the best hotels, what the best sites to see are, what festivals are coming up, anything you want to know about any place on Earth. It'll give you great information, but no one cares. Can't market it. We've tried a couple of times, doesn't market. People are not interested in talking to ChatGPT on their phone. It's not a thing. I know some people do it, but it's not a general thing that gets people excited to use it. It's not relatable enough. So that's where we are. Anyway, so when I see stuff like that, I'm like, you guys are gonna have a nightmare. And maybe I'm a crappy marketer, but I don't know. I mean, it literally is the coolest thing in the world when you're traveling. And I've given it to people and they absolutely love it, but as far as like trying to sell it to people, doesn't work. We're just keep hitting a wall on it. It's just not there yet. People haven't adopted AI into their lives to that extent yet. It's not how people relate to things. To me, it's like to me, it's like the Hitchhiker's Guide. It's like from the book. It's like it's a little electronic guide that tells you everything you want to know about everything. Why would you not want this? But it's not how people don't want to read it. It's too many words, and people don't want to put it into voice mode because it's too many words. And that's that's my fault maybe because I built it wordy because I thought it was cool to have all these intense descriptions and details and so on and so forth. But people really want to say what's the best pizza, and you say Zardy's and give them the address and they go. They don't want to know why it's the best. That's what I've learned. They don't want to know why it's the best. They don't want to know who else is number 2 and 3. They don't want to check the reviews. They just want you to tell them to go to Zardy's, and they go to Zardy's, and then they like it or they don't like it. It's weird. I care more about that stuff, I guess, and that's true about a lot of things. I think that's where it misses the boat. I think that's where Google always had it right. You would ask Google a thing, and they would tell you, and they've learned that with the AI. If you ask Google AI something, the AI strip. So, what's the best pizza near me? This is sponsored, blah, blah, blah. Oh, they don't have an AI for this. Oh, well. None of these are the best pizza. Okay, what's the best pizza in the World. There you go. According, this is what Google has learned. Una Pizza Napoleone in New York City, and I Massinielli in Cassata, Italy. Yeah, I heard about those guys. Are widely considered a definitive guide to the world's best pizza. Yep. Okay. Yes, everybody loves these guys now. I tell you, I don't know about Italy. I had good pizza in Italy, but I mean, if you want to find out where the best pizza is, ask New Yorkers, don't ask Italians. Not really their national food. But anyway, so the point is, this is what people want. They just want to know what the best pizza in the world is. You can click on a link, you can find out more information, you can show more. You can ask the AI questions and things like that, but Google knows what you want. You want to know the answer. And that's what it's going to do. It's going to give you an answer. It might not be the right answer, but it's going to give you an answer, and that makes people happy. So what I have to do is rewrite the guide and make it much more boring and much dumber, but people are going to like it more. Anyway, so that's where we are for now. Do we have any questions? Melvin says, in SPP, your Oracle adjustment says roll the Oracle puts to Oracle puts, but this is the 2027 prices, not 2028. It was 2027. I'm pretty sure we did the Oracle roll. Oh, it's supposed to be 2027. You're right. That's got to get fixed immediately. That is awful. Good catch. Thank you. Yeah, why roll to 2028 when I can do 2027? Very good catch. Can't believe nobody caught that earlier. Because we're going to do the LTP, STP, LTP. I can't believe I wrote the wrong one. All right, thank you. Same goes for the call spreads. Oh, wait a minute. No. Are you telling me that I took the wrong numbers on the call spreads? I'm going to have to look at that afterwards then. Damn it. The same goes for the call spreads. What are you saying? I use the 2027 numbers for the bull call spreads? These? That was really unintentional. All right. Well, I got to go. I got to fix that. Have a nice day, everybody. Thanks, Melvin. Appreciate it. And we will do this again next week. All right. Definitely, keep looking at the portfolio reviews. We got lots of trade ideas that are still good for a new trade. We have lots of adjustments that make it good for a new trade. And it's going to be an exciting market, and God knows what's going to happen tonight with NVIDIA. We ran it with the AIs. They had a big discussion. Everybody agrees. The consensus became that NVIDIA should actually have a pretty good quarter and should probably be projecting some strong numbers ahead. So in theory, it should not crash the market. But I think a lot of people are bailing proactively, have been bailing out. Well, okay, first of all, people don't know how to hedge. So if you don't know how to hedge, what's your choice? Your choice is binary: stay in the market or get out of the market. A lot of people have been getting out of the market. If NVIDIA has great earnings, they're going to have to come back in the market, and there'll be a big squeeze up. So I don't know if it's going to be enough for a squeeze up, but I do think that it's enough to say that the market is pretty stable. that NVIDIA is not going to wreck everything. But we'll see. I could be wrong. We're going to find out tonight. All right. Take care, everybody. Thank you for coming.